Hey guys, today we are diving into something you might have heard in business circles. Company debentures. Sounds fancy, right? But don't worry, by the end of this video, you will know exactly what debentures are, why companies use them, and how they work under Singapore law. Let's start with a story. Imagine you own a company called Sky High Ventures. Business is booming, but to expand, you need more cash. For example, for new equipment or to enter into a new market. You could go to a bank for a loan, but the interest rates are sky high. Alternatively, you could issue debentures. So what exactly is a debenture? In simple terms, a debenture is like an IOU. Your company is borrowing money from investors, but instead of going to a bank, you're asking the public or private investors to lend you money. In return, you promise to pay them a fixed interest rate over time and repay the principal at the end of the specific period. Now, here's the twist. Debentures can either be secured or unsecured. A secured debenture means that the company offers assets like building, machinery, or inventory as collateral. If the company defaults, the debenture holders can claim those assets. An unsecured debenture has no collateral backing, which is riskier for investors but has potentially higher returns. It's like lending your friend money. If your friend promises to give you their gaming console if they don't repay the money, that is called secured. If your friend just makes a promise to return the money, that's unsecured. The idea of debentures isn't new. The term comes from the Latin word debentur, meaning they owe. Historically, debentures were simply acknowledgements of debt used by governments and corporations to fund large projects, such as railways, bridges, or wars. The rationale? Well, companies need capital to grow, and issuing shares means giving away ownership. Debentures allow companies to raise funds without diluting control. For investors, it offers a relatively safer and predictable income stream, especially if the debentures are secured. It's a win-win. Companies get the funds they need and investors get steady returns. Now let's talk about the law, but don't worry, I'm going to keep it simple. In Singapore, company debentures are primarily governed by the Companies Act. Key sections you should know include Section 93, which outlines the issue of debentures by companies, the administrative provisions, and includes the rights of debenture holders. There's also Section 131 of the Companies Act, which talks about the need to register charges to secure the issue of debentures. If your company issues a secured debenture, the charge on the assets must be registered with ACRA within 30 days. Now let's bring this to life with 3 examples. A tech company called Innotech wants to expand globally, but doesn't want to dilute ownership by issuing more shares. Innotech decides to issue unsecured debentures worth 5 million, offering investors a fixed 6% annual interest. No collateral, but investors trust the company's growth trajectory. In this case, Innotech raises funds without losing control over its shares. Second example, a property developer called Skyline Builders needs funds for a new condominium project. Skyline issues secured debentures worth $20 million, backed by the land they own for the project. Investors feel safe knowing that if Skyline defaults or go bankrupt, they can claim the land, which is secure. This is a classic case of secured debentures tied to tangible assets. But like all financial instruments, due diligence is key. And remember, just because something is secured doesn't mean it's risk-free. Always assess a company's financial health and the value of the collateral. That's all for today's video. Don't forget to like, share, subscribe. I'll see you in the next one.